Okay, let's get settled in. Couple of things. One is your valuation, that first round is due next Friday, so I'm going to send an email out today about what exactly you need to turn in. Let me cut to the chase. All I want to see is your Excel spreadsheet valuation of your company. So there's no write-up involved, so send me a spreadsheet. If you're using one of my spreadsheets, fine. If you're using one of your own, that's fine as well. So the place to do then, if you have issues with the inputs, you can write it in as a comment or right next to the inputs, or put into your Excel spreadsheet whatever issues you have, and I'll see if I can respond to them. Okay. So all you need to turn in next Friday is the Excel spreadsheet with your valuation. Okay? This is not a modeling class, okay, which is I don't expect. I mean, I'm not. If you want to build your own spreadsheet, great. If you don't want to build your own spreadsheet, great. I don't care. Okay. What I'm looking for is a valuation, not a spreadsheet building exercise. Okay? So don't sit there spending the next 6 weeks building a spreadsheet, because if you want a class in Excel, there are far easier ways to get there rather than use this as a vehicle to get there. Don't get me wrong, it's a good thing to build your own models because it forces you to think about linkages. But it's a bad thing if you're spending the next 6 weeks learning Excel as you're going along building a model, because that's going to suck away from what you need to get out of valuation. So either way, send me the Excel spreadsheet. I will send you back the same Excel spreadsheet with the comments. Saying and as I said, my comments will not be, I don't like your growth rate. It might be, I don't think your growth rate and your reinvestment go together. I don't think your reinvestment and your risk go together. It'll be about consistencies that I think should be established. You can choose to override and just ignore what I tell you, or you can make the changes that are necessary. But that's basically the objective of the exercise. Any questions on? And you don't have to turn this in as a group. Right? Just turn in, because after all, this is your valuation. I'm going to send it back to you. You can just individually, whenever you're ready, send me your valuation, and I will get it back to you. Don't wait till Friday at 5 o'clock for everybody to turn it in, because if I can get some on Tuesday, some on Wednesday, obviously it makes my job a little easier. So if you get done earlier, don't wait for everybody else. Okay? It's not great. It might as well get it in as soon as you can, get the feedback as quickly as you can. No questions? So you guys get a chance to think about the loose ends I kind of laid on the table before. Even if you haven't, I'm going to put you to the test. Today I want to start off with what is viewed as one of those simplest things to do in valuation, which is how to value cash. And remember the first session I said if you have 100 million in cash, don't play games, it's worth 100 million. I'm going to re-examine that notion. In fact, let's think about the value of cash. Right? You have a big cash balance. You get interest income from the cash, right? If you're valuing a firm using free cash flows to the firm and cost of capital, interest income has not been counted yet. Cash is kept outside the process. You take cash flows from operating assets, you discount back at a cost of capital. What you have are the value of the operating assets. So there it's a no-brainer. Cash has to be added on to whatever you get as a present value. But if you're valuing equity, starting with free cash flowed equity, which begins with net income, it gets a little dicier. Do you see why? Net income includes interest income from cash. If it's in your cash flow already, you've valued cash whether you like it or not. You might have valued very badly, but you valued cash. If you add cash to that present value, you're double counting cash. So the first thing to look at is what kind of valuation are you doing? If you're doing a free cash flow to the firm valuation, the cash is entirely outside the picture, it's clean. If you're doing an equity valuation, look at what your measure of free cash flowed equities and see if it already includes some component of cash. And the reason it's a little messy is when you build it in net income and discount back at the free cash flowed equity, even if you keep things right, your cash flowed equity is correct and your cost of equity is correct, you're assuming that the proportion of the cash flow that's going to come from cash is going to stay stable over time, right? Because you're using the same beta over time, the same cost of equity. That's actually very difficult to do. That's why all my free cash flowed equity models, I give you an option. So those of you looked at my free cash flowed equity model, I start with the net income, then I ask you, what is the interest income from cash that's in that net income? Then I try to value your equity without cash. I take the net income from the interest income out of the net income, value the rest of the net income, and then I can do what I do with the traditional free cash flow to the firm valuation, which is add cash. So that's a standard practice. Either add cash on to a DCF valuation or assume it's already in there. Here's the question I want to ask you. So I'm going to come to you with 3 companies. I've done all the dirty work for you. I valued the enterprise. I've taken the free cash flows of the firm, discounted the cost of capital, and come up with an enterprise value of $1 billion for all three companies. Each of the three companies has $100 million in cash on its balance sheet. Assume that that's the right cash balance, that in fact they're not lying about it. This is not Satyam that we're talking about here. These are actual $100 million cash balances. Okay? But here's where they differ. Company A has a return on capital of 10% and a cost of capital of 10%. Company B has a return on capital of 5% and a cost of capital of 10%. Company C has a return on capital of 22% and a cost of capital of 12%. Company A and B are developed market companies. Company C is an emerging market company. So A, B, and C look exactly the same in terms of the numbers, right? $1 billion enterprise value, $100 million in cash. The question I'm asking you is, given those other differences between the two companies, the returns they make and the fact of location, are you going to treat cash differently in the three companies? In fact, I'm going to argue that in one of these three companies, you're going to treat $100 million in cash as worth $100 million. In one of these three companies, you might discount cash. You're going to treat $100 million in cash as worth less than $100 million. In one of these three companies, you might attach a premium to the cash. Let's start with the easy one. Which of these three companies is $100 million in cash most likely to be worth exactly $100 million? And what is it about A that leads you to say that? What kind of company is A? We talked about blah companies. This is a blah company, right? But don't get mad at blah companies. It's often better to have a blah company than the other kind of company. A blah company earns its cost of capital. It does no good, it does no bad, it basically is there. So there, $100 million in cash is worth $100 million. In one of these three companies, as I said, you're going to discount cash. Which of the three companies do you think that's going to happen? When I was in Brazil, I put the same example up. Every single person in the group said C. But that reflects, I think, geographical bias, right? Which is, they had played a soccer game in the previous week or something. Emotions were running high. What is it about company B that should lead to the discount, though? What is it about company B that scares you? You see the cash balance, right? The cash by itself has never hurt an investor. It's what managers can do with the cash that scares you, right? And what's the history of this company? When managers have done something, what have they done? They've done bad things. I call this a stupidity discount. Basically, you're saying there's $100 million in cash. I'm going to discount that cash because this is a really stupid management team. They're going to figure out a way to screw me over sometime soon, and it's going to cost me another 10 or 15 million. And in company C, by exclusion then, I'm going to argue that there's going to be a premium for two reasons. What's the first reason that might have a premium? What kind of projects do they seem to have taken historically? They've taken good projects, right? Why would the emerging market, developed market distinction even matter? What's the advantage of having a large cash balance in an emerging market? Yes? In fact, if you have unlimited access to capital, would you ever need a cash balance? If you have great projects, what are you going to do? Go out and raise capital whenever you want it. In fact, in traditional corporate finance, that's the reason people say, hey, you don't need cash because you can always raise capital. If capital markets can shut down, you can already see what the advantage of a cash balance is. If you're an Argentine company in 2001 with a big cash balance, you were in the driver's seat, right? Because all the other companies around you were so desperate for cash that you could buy assets on pennies on the dollar. In fact, we've just discovered in the last 6 months, it's not just emerging markets that might have capital access be cut off. We're just discovering that it can happen in developed markets as well. In fact, we can make the argument that the same cash balance today is going to be respected and valued a lot more than it was 6 months ago or 9 months ago. That same company we laughed at for having a $15 billion cash balance, I wish I had that cash balance now. So what I'm saying is, even though in conventional practice and valuation we act like $1 in cash is worth $1, it is conceivable in the real world that in some companies $1 in cash will be discounted. In some companies it's going to be worth $1. In some companies there might be a premium. And the reason is not because it's cash. I've actually heard analysts say that cash is bad because it earns a low rate of return. Does cash earn a low rate of return? Absolutely, right? It's invested in commercial paper and T-bills. Of course it makes 2%. But that by itself is not a reason to discount it, right? Because what's your required rate of return on that cash? It's riskless, it's short term, it should make 2%. Cash by itself is not a bad thing. It's what investors do with the cash that can hurt you. That's why an Apple can have a $20 billion cash balance and not be hurt. That's why a Microsoft spent 20 years of its life building up these huge cash balances and nobody ever turned on it. Because as long as people perceive that you're careful with your investments, the fact that you have a big cash balance doesn't hurt you. So discount cash for the right reason. The right reason here is that you don't trust the managers of some companies with big cash balances, partly because of who they are and partly because of their history. I mean, let's face it, you do not want Time Warner's management to ever have $1 of your cash. I don't. When I see $1 in cash, I say, please give it to me now. Because I've seen what you've done with cash when you have the cash, right? It's amazing how quickly people can screw up cash, and some managers, should be a law, no cash in this company, ever. Now, this might sound outlandish. Does the market actually discriminate across companies like this? Here's the result of a very interesting study. The result maybe 7 or 8 years ago. Here's what the study tried to answer. They wanted to see how much the market valued $1 in cash in the hands of different companies. How the heck did they even try to answer the question? They took every publicly traded U.S. company, they took the market values of the companies, and they ran a regression against the cash balance. So basically they threw in all the variables, growth, risk, etc., and they threw the cash balance in. So on the left-hand side of the equation, you've got the actual market value. On the right-hand side, you've got all the variables and cash as an independent variable. They looked at the coefficient on cash. You see what that tells you? If you see a coefficient of 1, that means cash is valued as cash. $1 in cash is valued as $1 in cash. Here's what they found. Across all U.S. companies, $1 in cash is valued at about 96 cents, which is pretty close to dollar for dollar. So what we do in conventional practice is not bad across the board. But here's where the numbers became a little scary. They focused on a subset of companies, mature firms that earned less than the cost of capital, companies very much like Company B. And you know what? $1 in cash is valued at about 69 cents. Think about it. What have I just said? You're a mature company with a $10 billion cash balance. The market is treating it as worth $6.9 billion. In fact, if you were giving value enhancement advice to this company's management, they're complaining about how low their stock price is. What's the advice you're going to give them? What's the easiest way for them to enhance value? Give the cash back. Don't say get rid of the cash. With this management, who knows how they will get rid of the cash. They'll have a big bonfire in the back and all cash is gone. Give the cash back. If people don't trust you with the cash, don't fight it. You know how difficult it is to get this message across to managers? You take a company like Intel. We've been fighting this fight for 5 years. The market, in my view, has been discounting cash in the hands of Intel for 5 years. And every year Intel says, they've got it wrong, we're going to fight it. But if the market doesn't trust you with the cash, there's no point fighting it. You either get that trust or you don't have that trust. And if people don't have the trust, they're going to discount the cash. Here's another subset of companies they looked at. They looked at growth companies with high excess returns, companies like Company C. $1 in cash was valued at $1.22. So next time you see a small tech firm with a big cash balance, and the analyst jumps on it and says, how come you guys have such a big cash balance? Jump back. That company with a large cash balance, that might be a good thing. This might be what allows them to survive the next downturn. They don't have the access to capital that larger companies do. So it actually, I'm not saying you change the way you do valuation. Still add the cash balance on, but think about it. Look at your company's history because it's going to give you some insight into why the stock price might be lower than your value per share that you're computing, especially if half the company is cash and it's a bad track record. Now, that's with cash, right? Cash is the easiest of all assets because you can see it, you can count it, you can get the value. But there's another subset of assets which is almost as easy to value, which are financial assets. You own stocks and bonds in another company. The market value, it's a publicly traded asset, right? You have the market value right there. So if you have a company whose entire asset base is composed of stocks and other publicly traded companies, it should be the easiest of all companies to value, right? Right now, you just add up the values of all of those stocks, you divide by the number of shares, you should get a value per share. Are there companies like that that actually own shares and that's all they own, is shares in other companies? Now, how mutual funds are categorized in the U.S.? You have open-end mutual funds, which are, Fidelity, Magellan, etc., and where you send in money, the number of shares expands. Or you have closed-end mutual funds, which are Actually, companies that own shares in other companies, and you buy shares in the company. What's typical about closed-end mutual funds? Is the price trade at a discount or a premium on the stated value? It's one of those big puzzles in finance. Is if you look at closed-end mutual fund companies, they typically trade at a 15% discount on the value of the shares in the company. You know why this is a puzzle, right? Because what's the immediate arbitrage that comes to mind? When you see a company with a market value of securities, these are publicly traded securities of 100 million, and the stock is trading for 85 million. Seems like a no-brainer, right? How could you make money? You go in and acquire all of the equity in the company for 85 million. Now you own the company, you liquidate the assets, you make 100 million, you should keep the difference. And sometimes you do see closed-end mutual funds being bought out and liquidated. But if you look at the discounts can be 25, 30, 35, 40%. However, that assumes, this arbitrage assumes you can buy the fund, liquidate it, and if you look at where closed-end funds are headquartered, they're often in places we can never get to them. Where basically doing this is almost impossible to do. So let's assume that the arbitrage is off the table. You can't do it. But let's ask a more fundamental question. Why is there a discount? I mean, if you have $100 million in securities there, why isn't the value of the equity $100 million? What do we worry about with the cash? What the managers might do with the cash, right? If this is an ongoing mutual fund, you basically expect them to make some returns in the future. If you expect a mutual fund to underperform the market, the long term, because the managers have that history, they deliver 1% less than what they should be, guess where you're going to show it? You're going to reduce the current 100 million by the expected discount. In fact, let's take some numbers and you can see very quickly what I mean. Let's assume you have a mutual fund where based on their risk, you put in the beta and you put in whatever risk measure you have, you expect them to make less. So given their risk, you need them to make 11.5% a year. But because of transactions costs and all the other costs, they're making only 11% a year. And you expect this to continue forever. Assuming no growth, can you tell me what the discount on this closed-end mutual fund is going to be? With those two numbers, you should be able to do it. Let's put some numbers. You have $100 invested in the fund, right? You're going to make on an expected basis how much each year? $11 a year, right? What's the present value of the $11 with no growth? It's present value of $11 each year forever, discounted back at what you need to make, which is 11.5%. $11 as a perpetuity, discounted back at 11.5% forever is going to give you like $96. There's your 4% discount right there. A 0.5% underperformance translates into a 4% discount. A 1% underperformance might translate into a 10% discount. You can actually take the discount on a closed-end mutual fund and back out what people are expecting that fund to do in the long term below what it should be doing. So there's actually a rational explanation for why there's a discount. If you expect a mutual fund to underperform, to actually deliver a return lower than its required rate of return in the long term, the only place you can correct for that is in what you pay for the mutual fund up front. And it shows up as a discount on the market value. Yes, Malik. It's not a discount rate as such, right? Because it's a probability, which is what will they do that will cost me money, right? So if you think there's a 20% chance they will do an acquisition and overpay by 100 million, that's 20 million right there, right? 20% of 100 million. So it's tough to tell. One way you might be able to quantify it is to do what we do with a closed-end fund, right? Which is you take the actual returns on cash and you discount it back at what you need to make. So in a sense, that might be one way you can get around it. You can say, this is 100 million in cash. Given their risk, this is what they need to be making. But given their history, this is what they will make. So you can take company B, take 100 million in cash, let it earn 5% a year, and discount that 5% back at 5% a year at 10%. And there will be a 50% discount on the cash right there. So it's actually a function of what you think their excess returns will be, not so much on the cash, but what they invest that cash in. But if you're willing to make assumptions about what they earn above or below the cost of capital, you in effect can quantify the premium or the discount. For your valuation, I'd say stay as far away from that as possible, because in a sense, you're going to be valuing the company and saying, hey, the company has the option. It can return the cash. Let's value the company as is. But I'm saying the market price might be lower than your value precisely because of the discount the market is attaching. Yes? But the shares are, liquidity is actually the arbitrage, right? So you cannot do the arbitrage because you might not be able. There are lots of practical problems. It's liquidity, it's taxes. You see why taxes are an issue? I told you the value of the securities is 100 million, right? But if you liquidate this fund and you sold all the securities for 100 million, you might have to pay taxes on the 100 million. So those are all practical reasons why the closed-end fund persists. Because in any liquid market where you didn't have these closed-end funds should be closed like that, right? There should be none left. So we can talk about why the discount persists, but the question I'm asking is why does the discount exist in the first place? And for that, liquidity cannot be the reason. It has to be something fundamental about these funds that's leading us to reduce value to reflect what we think they will do in the future. So embedded in that discount are messages about what the market thinks about what they feel you can make as a return versus what you should be making. So take a look at some closed-end funds. There are dozens out there. Take a look at some of the discounts and premiums. See if they're correlated with what kind of excess returns that fund has delivered historically. Any other questions on closed-end funds? Yes? In fact, let's take a flip side, which is it possible that you could have a company invested in securities of other companies and you pay a premium over the market value of those securities? What do you have to believe about the capacity of this company then to make investments that its investments will earn above the cost of capital? Have you ever taken a look at Berkshire Hathaway? Berkshire Hathaway has two components, right? There's the old insurance company, and you have the investments that Berkshire Hathaway has made in securities. Most insurance companies, when they invest in other securities, basically you get a pass-through. They invest $1 billion in securities, the value increases by $1 billion. Berkshire Hathaway, actually, one of the interesting things is if you separate out the securities they hold, you're actually paying twice the market value when you try to buy those securities through Berkshire Hathaway. So here's one way to think about it. One of Berkshire Hathaway's biggest holdings is a holding in Coca-Cola. Can you buy 1,000 shares of Coca-Cola by yourself? Sure, right? You'd pay about $35. If you buy Berkshire Hathaway, you'd get the same 1,000 shares, but you're actually paying $65 or $70 for those shares because that's the markup on the value of these securities that you're paying as a premium. So why are you paying this premium? What is it about Berkshire Hathaway that leads you to pay this premium on the market value of the securities? Remember didn't Warren Buffett once do an auction where he auctioned off an empty wallet with one slip of paper with the name of a company? I'm not kidding. This was about 2 years ago. And somebody paid, I think, $15,000 for an empty wallet with a piece of paper that Warren Buffett had written the name of a company. This is the Warren Buffett premium. If you have, what is it, $100,000 to buy a Berkshire Hathaway share? Here's my note of caution. Warren Buffett is almost 80 years old. He will die. I'm not being morbid about this. He is human. He will die. And when he dies, this premium's going with him. So you're making a joint bet here that he'll keep picking stocks. He'll stay alive for long enough for you to make your money and move on. I don't know whether you want to toy with divine providence this way because it's going to come back to get you. But this is the flip side. You can actually see securities being marked up if you believe that set of investors. So if you make an equity investment in other companies and you're really clever about these investments, you manage to find the right companies to invest in, it's conceivable that the market might attach a premium to those equity investment values. The only problem is there aren't too many Warren Buffetts out there. You very seldom see these premiums attached because in most cases, the best you can accomplish is neutral, which is you're not hurting yourself with these investments. But if you have a track record of making great equity investments in other publicly traded companies, no reason why it shouldn't pass through. So that discussion of cash actually has lots of relevance in closed-end funds and companies which invest in securities of other companies. You think about whether they trade at a premium or discount. It all boils down to how good you think they're at picking those securities. Second issue. The way I described this on Monday was my nightmare scenario in valuation is to value a company with lots of cross-holdings. In fact, let's step back and let's think about how accountants classify cross-holdings, at least in the US, and it actually spills over to lots of other accounting systems. Let's say you own 5% of another company and you take absolutely no role in how that company is run. It's called a minority passive investment. And if you have a minority passive investment, this is what you show on your income statement from that holding. In fact, You can help me out. If you have a minority passive investment in your income statement, you have to show what? Only the dividends you receive from those holdings. So if you have a minority passive investment in Google, guess what you show in your income statement for that holding? Nothing. And as an example, SoftBank in the late 90s, a Japanese venture capital firm, got 75% of its value from one holding, a holding in Yahoo that was classified as a minority passive investment. 75% of your value. This is what, at that time, a $25 billion investment. Nothing showed up in your income statement because it was classified as a minority passive investment. So if you have a minority passive investment, the only thing you have to show in your income statement is dividends received, and what you show on your balance sheet is the original book value of your investment. Think of how scary that is. So what SoftBank is showing on the balance sheet is what they invested as venture capitalists in the late 80s in Yahoo was shown on the balance sheet. So this is your worst case scenario, right? The information from the income statement and balance sheet bear no resemblance to the actual value of the investment. So that's minority passive. One step up. You own 10, 15, 20% of another company, and you do play a role in how that company is run. You have a director on the board, you play some role in the management. That's classified as a minority active investment. If you have a minority active investment, you have to use what's called the equity approach to reflect that holding. In an equity approach, you own 15% of a company. When you do your income statement, you have to show 15% of the net income or net loss of that company as part of your income. So it'll be below the operating income line, but you'll see net income from 15% of the net income of that subsidiary. So it's a little better, right? Instead of dividends, at least you show some net income. On the balance sheet, you show the original amount you invest in the company plus or minus your share of retained earnings since you made the investment. So it's like an updated book value. It's a little better than minority passive. You have an updated book value, percentage of net income. Then you get to 50, 55, 60% of a subsidiary. Accountants flip out. This is classified as a majority holding, right? If you have 55% of another company, what do accountants require you to do? Consolidate. I've never understood this. So what do you do in consolidation? You act like you own 100% of the company, right? You're complaining, I own only 55%. The accountant says, don't worry about it. Act like you own 100%. You count 100% of the revenues, 100% of their operating income, 100% of the net income. All the time you're complaining, I own only 55%. The accountant is ignoring you. Then you get to the balance sheet. On the asset side, count all of the assets. I own only 50. No, count all the assets. Then at the very last stage in the process, the accountant wakes up and says, but you own only 55%. You say, that's what I've been trying to tell you all this time. You don't own 45%. Genius. You have to show the 45% that doesn't belong to you somewhere, right? So what's the item on the balance sheet that you see that reflects the 45% that doesn't belong to you? Minority interest. That's why it shows up on the liability side. Minority interest reflects the 45% of the equity that doesn't belong to you. It's one of the worst named items on the balance sheet because you see minority interest. You think it's a good thing. Then you say, oh my God, it's on the wrong side of the balance sheet. They screwed up. Let me move it back to the right side. Don't do that. This is a reflection. This is the residue of consolidation. Is you treat all the income. You can already see why cross holdings are already going to be a mess, right? Because the first step, when you want to value cross holdings, you have to figure out how they've been accounted for. Minority passive, minority active, or majority, because the information you get will reflect how it's been accounted for. Right? In fact, let me set up this process with a very simple example, because I think this will bring home how both people treat minority holdings now and what's wrong with it. Let's assume you have a company. Let's call it Company A, with consolidated financials, and I've underlined it to illustrate that something's been consolidated. So if you see the word consolidated, there's already a message there, right? They have a subsidiary that they own more than 50% of that's consolidated. So you value the firm at a so you take the operating income, free cash flow to the firm, discount back at the cost of capital. You value it at $1 billion. Debt is $200 million. This is not a trick question. If you value the firm at $1 billion, debt is $200 million. What's the value of equity? It's not a trick question. Come on. Billion minus $200 million is $800 million, right? So that's the $800 million value of equity. Now I'm going to add a couple of wrinkles to this game. First, I tell you that Company A owns 10% of Company B, and that the holdings are accounted for as passive holdings. Okay. If the market cap of Company B is $500 million, what's the value of equity in A now? So the question I'm really asking you is, when you valued equity at $800 million, have you reflected any of the value of Company B yet? What did you do for when you valued the firm? You took free cash flow of the firm, right, which came from operating income. This is a minority passive holding, so it's not part of operating income. If you have minority passive investments, in fact, if you have minority investments in general, when you do free cash flow to the firm and discount back at the cost of capital, you haven't valued any of them yet because they're all below the operating income line. So what's your answer now? Now that I've thrown this, so 800 million was the value of equity before I threw this piece in. You now own 10% of company B. It's classified as a minority investment. Value of equity is 800 plus 50, not minus 50. Don't go the wrong direction. 800 doesn't include the value of the 10%. Now that you brought it in, the 800 plus 50, which is 850, right? Everybody with me so far? Now already you can say, please God, let this be the only minority holding, because I told you there were 33 other minority holdings. You can see that the rest of your life is laid out in front of you right there, right? Because you've got to value each of them and bring them in. Now let me add the final wrinkle. That's the only minority passive holding, so you're done with that. Then I also tell you, oh, by the way, I forgot, Company A owns 60% of Company C. And the holdings are fully consolidated. That's what the consolidated. So when you use the consolidated statements, that operating income included the operating income for Company A and 100% of the operating income of Company C. CapEx included 100% of. So everything you did to get to the free cash flow of the firm reflected two companies, right? 100% of two companies, but you own only 60%. So that 850 million we have in equity right now includes 100% of Company C, whereas you own only 60%. Minority interest in this company is recorded at 40 million. So what should I do with the minority interest? Add it, subtract it, ignore it. You see why you subtract it? But when you subtract it, what are you implicitly telling me? That 40 million is 40% of the value of Company C. But this is a balance sheet item, right? This is the accountant's measure of the 40% of Company C that belongs to you. It's a book value. It's not a market value. So when you subtract out the 40 million, you think you're done, but you really aren't. 850 minus 40 is 810. You say that's the value of equity? But that's not going to be the value of equity, because 40% of the true value of Company C might be 400 million for all you know. Might be 200 million. So when people subtract out minority interest, and you see this often with enterprise value to EBITDA calculations, equity plus debt minus cash minus minority interest, and you ask people, why are you doing that? Take out the effect of You're not doing it because minority interest there is a book value number. This isn't a clean way to correct for it, but it's a way in which most people correct for minority interest right now. They just subtract out the book value of minority interest, throw up their hands and say, I'm done. Anthony, question? So if you believe this calculation, then the value of equity is 810 million, right? It basically is the 800 million you started with plus 10% of the market price of Company B. So you're already cheating because you were doing an intrinsic valuation, and there you kind of took off and did a market price, minus 40 million, which is a book value. So this is kind of a mishmash, which is neither fish nor fowl. This is not an intrinsic valuation. It's not a relative valuation. It's not even an accounting valuation. It's a little piece of each. But this is the state of the art with cross holdings. So shall we do this right? To do this right, what do I need? I have a value for Company A, right? Rather than give you the market value for Company B, what would you rather like? If you were doing an intrinsic valuation, you'd like a intrinsic value of Company B and an intrinsic value of Company C, right? In fact, if I gave you all three of those numbers, then the exercise becomes fairly trivial. Because then here's what I'm going to do. Let's assume you do your own valuation of equity in Company B. Rather than trust the market price of 500 million, you come up with 250 million. So 10% of 250 million is 25 million. So 800 plus 25 million. Replace the 50 with 25. I also do a valuation of Company C and come up with 250 million. So let me tell me what the final step is. I took 800, took 10% of Company B to get to 825. What's the last step? What do I need to subtract out? 40% of Company C, which is 40% of 250 million, which is 100 million, which gives me an end value for the company of 725 million. Now do you see why I call this a nightmare scenario? It's so easy to add when you should be subtracting, subtract when you should be adding. Cross holdings are a nightmare because depending on whether you're doing minority or majority interest, sometimes you're adding, sometimes you're subtracting. Just do it one step at a time. If you try to jump steps, you're going to get into serious trouble. The value of equity, the intrinsic value of the equity in this company is going to be 800 plus 25 minus 100, with all three numbers coming from intrinsic values. Okay. Yes, sorry. Doesn't matter. It's like a simultaneous equation, right? keep them separate. In fact, in a perfect world, let me describe what you'd rather do, and that it might give you some insight into what to do when you have Spanish companies, for instance, are notorious. You see these pictures of companies. It's almost like they're trying to get you. 8 companies kind of cross-holding each other. You have no idea what you're buying, like a complex equation when you buy these 8 companies, because company A is 40% of company B, which is 30% of company A. You have no idea what you're actually buying. In a perfect world, we'll talk about what to do, but Louis, you had a question? Okay, I start with the 800 million still, because that was an intrinsic value, right? I take 10% of company B, because that's a passive valuation. I haven't valued 10% of 250 is 25, so 800 plus 25. Then I subtract out 40% of company C. But I was taking the market. So all I've done is the previous time I was taking 10% of the market price. But if I'm doing an intrinsic valuation, I should be intrinsic all the way through. So the difference here is I value the equity at 250 million, which is half the market price. So I'm going to replace the 10% of 500 with 10% of 250. And I'm going to be subtracting out 40% of 250 rather than the accountant telling me it's worth only 40 million. So don't trust those minority interest numbers. They don't take care of the problem, right? Because your problem is you don't own 40% of the company. The accountant's trying to tell you what it's worth. But that number might bear little or no resemblance to reality. So let's talk about what we would do in a perfect world. In a perfect world, here's what I'd do. I would never try to value a consolidated company. It's asking for trouble. Do you see why? Because we have a consolidated company. What are you trying to do? You're trying to value company A and C with a cost of capital. In other words, you're trying to value 2 companies at the same time, trying to consolidate, come up with one cost of capital. If you have a steel company that has 60% of a technology company, think of how difficult it's going to be to try to value the combined company. So if you have a consolidated company, and as I said, as I go along, the information might get in the way. First, I'm going to try to value the parent company. In this case, company A is standing alone with no cross-holdings at all, which means I have to clean up the operating income and look at the operating income of just company A. Cost of capital of just company A. Then I'm going to value each of the cross-holdings separately. Company B, company C, just as I did. Last stage in the process, I take the value that I got for company B, company A, then I take the percentage of company B and C. So I no longer have to worry about minority interest, right? Because I valued company A standing alone. I now take 10% of company B and 60% of company C. I'm done. And it's always added on, because every cross-holding now can be added on in order to think about, now, what should I add, what should I subtract on? To do this, though, what's the fundamental information I need? I need information about the parent company. I need full financial information on each of the subsidiaries, right? Yep.
Similar to oil and gas companies or mining companies that have percentage ownership of different assets?
Absolutely. It could be joint ventures. This is not an uncommon problem. In fact, in Asia and Latin America, this is the rule, not the exception. You can pretty much guarantee that every company you value, you're valuing pieces of other companies in it. And you're trying to do it all in one go, you're asking for trouble, right?
Normally do not provide financials for the
That's the problem. The information you have is going to get in the way. First, some companies won't even give you parent consolidated. They'll just give you consolidated, right? Second, even if a company gives you the parent company information, they might not give you full information of the subsidiaries. And third, this is fine when you have 3 or 4 subsidiaries, but what if you have 30? I'll give you my favorite example. This happened about 10 years ago. I was writing one of the editions of my valuation book, and I was valuing a Japanese company. And I did the valuation. I was very proud of myself, because Japanese companies are always teetering on the edge of disaster. Part of the reason for that is that risk-free rate of 1.5% can get you into trouble, because you use any growth rate you're used to using in any other market, it's going to blow up in your face, right? 4% stable growth rates. You put that with a 1.5% risk-free rate. So I followed every rule in the book, even though it's, the book might have been mine, so it's okay. Right? But it's my rules. I followed my rules. I came up with a value for the company. And then I kept reading the annual report. And I saw an item there that scared the wits out of me. It said this company had 217 cross-holdings. Now my job's laid out for me, right? In the perfect world, what should I do? Value each of the 217 cross-holdings and take the percent of each. But here was the scarier thing. 3/4 of those cross-holdings were in private businesses. Because at least if it's a publicly traded company, I can go look up the 10Ks, the annual reports, because it's publicly traded, I can get the information. So about 50 of the companies, I had that up. The remaining 167, there was nothing, zero information provided about those companies in the annual report. No revenues, no operating, nothing. So I called the investment relations officer of this company and said, look, I'm valuing a company. It's not for an expose. I'm just valuing it for my book. I need some information in your cross holdings. And she said, we cannot give you that information. It's proprietary. I said, okay. What if I bought 1,000 shares in your company and then called you? She said, it'll still be proprietary. I said, what do you mean it'll still be proprietary? I'm part owner of your company, and you're refusing to tell me what I own. She thought about it for a moment. She said, well, you have a point there, but it's still proprietary. So I realize I'm hitting my head against a brick wall here. I get ready to hang up the phone. She says, wait, I do have something to add. I said, maybe she's going to give you some information. She said, I cannot give you any information about these cross-holdings, but I should tell you they're worth a lot. Just to string her along, he said, how much is a lot? He said, 2-3 billion, something like that. How the heck do I know that? And in a sense, this cuts to the heart of the cross-holding culture, right? Companies hold up a brown paper bag to you. Trust me, it's full of cash. And then look in the back. No, you can't look in the back. It's full of cash. When you're in New York, somebody walks up to you in the street. Trust me, it's full of cash. But you can't look in the back. What's your first reaction? There's no cash. That's probably full of IOUs. I'm going to knock 10 billion off your value, not add 10 billion to your value. But as long as we take managers at their word, what's the incentive for them to tell you what's in the bag? You're taking them, 10 billion, okay, I'll add 10 billion, 5 billion, I'll add 5 billion. So I've kind of devised my own roundabout ways of dealing with the fact that in the real world, you're not going to get the kind of information you need to actually get this. So here's what I'm going to do. Rather than trust that I will get the raw information, I'm going to try to estimate the market value the best I can with the information you give me. For instance, if you told me the book value of your holding, I'm not going to take the book value as a given. I'm going to try to estimate the market value. So example, remember that $40 million minority interest? Let's suppose I told you that the minority interest, company C, was a chemical company. And you told me the minority interest is 40 million, and you told me it's a book value. Is there a way I can get from that 40 million, which is the book value of the chemical company, to an estimated market value? What's a logical way to do it? There are other publicly traded chemical companies out there, right? I can look up a price-to-book ratio for a typical chemical company. Saying, but it's an estimate. Well, you're using an estimate of 1 for the price-to-book when you use the book value. I'd much rather use a more reasonable number. If the average price-to-book across chemical companies is 2.5, I'm going to take the 40 million, multiply by 2.5, and come up with an estimated market value for the minority interest of 100 million. I know it's not perfect. I'd much rather have the intrinsic data and do the valuation myself. But beggars can't be choosers here. So if you have multiple holdings, try to estimate the market value. You'll have a book value, try to estimate the market value. I know it's an estimate, but it's worth the effort of actually building up to it. In fact, in the next couple of sessions, we'll be valuing Hyundai Heavy, which, like most family group companies, actually has holdings in 6 other Hyundai companies. They're all classified as minority holdings. I'll take you through the process of how I estimated the market value of those minority holdings from the book value, because the book value was given. But I'd estimate the market value using these ratios. It's better than taking the book value as the value of these holdings. Yes? Well, not even a full, right? Because it's very, very, very first. Because you don't have any of the other fundamentals to control for. So it's not, that is what you're doing here is actually a very partial relative valuation. In a full relative valuation, you'd adjust the multiple for differences between your company and the rest of the sector. You don't have that luxury there. No, stay with an intrinsic valuation, because you're basically saying, I'm still trying to do an intrinsic value. You're just holding back the information. I need to do an intrinsic value. So I have no choice, right? So what is really the choice? I would, as I said, in a perfect world, I'd like to do intrinsic value for everything, but we don't live in a perfect world. Third question. So any questions on cross-holdings? I'll send you a little write-up on cross-holdings. It is very confusing to deal with, actually, because all the pluses and minuses. I'll send you a little table that'll let you kind of use. Let's talk. Yes, go ahead. Public. You can do it. It depends on how big. See, let's keep it in perspective. If you are a $50 billion company and you own 1% of a $2 billion market value company, I'm probably going to say, well, it's not going to make enough of a difference for me to. If you take LVMH, right? Christian Dior. You have to do this. I mean, Arnault has basically tied these companies up at a Gordian knot. To value one company, you've got to value every other piece of the company. Because there, 35% of your value of your company can come from the other company. And you cannot take the market price as a given there, because then you're feeding in whatever mistakes they make. So look at the size of the cross-holding. If it's a big cross-holding, you might have no choice. If it's a small cross-holding, then you can use a shortcut and move on. Okay? Yes? You don't need to make that assumption, right? Because your valuation is as of today. So if your percentage changes, then obviously they've got to bring money in and take money out. So if you ask me what's the value per share today, it should reflect your percentage of that company you hold today. Okay? So even if I expect you to double that holding in the future, that's not going to happen for free. You've got to bring capital in, so that'll depend on what price you get in. So there are too many unknowns in that equation to try to bring that in. So I would just say stick with the holdings today, stick with the percentage today, value the cross holdings as of today. So now we've talked about cash cross holdings. Let's talk about a third issue. Is there something else that I haven't counted here? Because think of how we value a firm. We take free cash flows of a firm and discount back at the cost of capital, right? So any asset whose earnings are part of operating income, we've already counted. Any cash flow generating asset, we've already counted. So my open question is there anything else I should be adding on here? So I've taken the value of the firm, I've added cash, I've added cross holdings. What else can I be adding here? What else could I be missing in a company? Don't tell me things like brand name, because that's already in the operating income, right? Through the margins, through the cash flows. So what other assets could there be? No. Give me an example. You have a CEO who loves Picassos. Hey, let's face it, as shareholders in the company, we all own a piece of that Picasso, right? You just go try and say, I'll borrow the Picasso for a couple of weeks. They might not give it to you, but technically those belong to you. I mean, AIG, when Maurice Greenberg was accumulated art holdings. In Europe, publicly traded companies have accumulated all kinds of stuff on the side. I remember doing a training program for Deutsche Bank about 25 years ago. And they did the training program in a beautiful, beautiful hotel outside in a place called Jugendheim, which is about 50 miles out of Frankfurt. And we were the only people in the hotel. And I was a little curious as to how come there was nobody else here. So I asked around, and it turned out that Deutsche Bank owned the hotel. And I said, what's Deutsche Bank doing owning hotels? And they said, we own stuff like the chateaus, hotels all over Europe. And I said, do your stockholders know? And they said, I don't think they need to know. And I think that cuts to the chase here, right? If you invest in Tattinger, I mean, let's face it, Claudia Tattinger probably lives in a mansion, and the mansion probably is technically the company's holding, but you try to move into the mansion with her, she's not going to let you. Here's a much more immediate example. It happened last year. Somebody's valuing Playboy Enterprises. So they came up with the value of Playboy. It was about $220 million. The stock was trading at $270 million. But here was the catch. Looks like it's overvalued, right? Stock's trading at $270. The discounted cash flow value is $220 million. There are two big assets, though, that were not part of the $220 million. The first is Hugh Hefner lives in this Playboy mansion. Have you ever driven by it? It's about $50 million, which belongs to the Playboy company. It doesn't generate any cash flows. I mean, all those playmates jumping around, I guess, but those are kind of peripheral cash flows, right? So you've got this 85-year-old guy who never gets out of a bathrobe, who lives in that house, and he said, that's really Playboy. So the person doing the valuation asked me, should I be adding the value of the Playboy mansion on to the two? I mean, technically it belongs to Playboy. It's not in there already because it's not counted in the cash flows. In fact, there's some accumulated artwork work there that could add on another 20 or 30 million. So that could conceivably take your company from being undervalued to overvalued, right? So that's actually an open question. Should we be adding 70 or 80 million? Here again, age does matter. 85-year-olds in bathrobes don't stay in bathrobes. The rest of their life might be actually a very short rest of their lives. No, 90, 92. I don't know. Maybe you check his grandfather, father, see how long they live, and make a bet on this. If you get a news story, he's caught a cold, double pneumonia, go out there, buy the stock because the stock price is going to reflect that. But this is again one of those cases where you have an unutilized asset that you're adding on. But it's very unusual to see assets like those, right? I mean, if you see them though, the value of those assets is going to be trivial. In most cases, when people say they're adding the value of an asset, they're often double counting. Here's what I mean by double counting. See the company, Sears, retail company, right? Let's suppose I do a discounted cash flow valuation of Sears as a retail company, and I come up with $2.5 billion. I then value Sears as a collection of real estate holdings. It has a lot of leases around the country, and I come up with $3 billion. So I have two values, right? $2.5 billion is my DCF value of Sears as a retail company. $3 billion is my value of Sears as a collection of real estate holdings, and you're an investor. So here's my question for you. I'm going to give you three values for Sears, and I'd like you to tell me which of these three values you'd attach as a value to Sears. I could use the $2.5 billion, which is the present value of cash flows as a retail firm. $3 billion, which is the value of Sears as a collection of real estate holdings, and $5.5 billion, which is the sum of the two. Which number is clearly off the map? You can't use. Why? You can't have your cake and eat it too, right? If you count the last one, you know what you're telling me? You're going to be able to sell off these real estate holdings, but the nice people who buy these holdings from you will tell you, don't worry, just run the stores, act like it's your own. And if you can find those buyers, all the more power to you. But if you sell these lease holdings, you basically have to shut down as a retail business. So the 5.5 is clearly double counting. You cannot have a set of real estate holdings and a retail firm both coexisting in the same DCF valuation, which leaves us with a tougher choice. $2.5 billion or $3 billion. You think, let's be conservative, go with the lower of the two numbers. Let's not go down that road, because then you just attach a value of 0. You're being very conservative on the valuation, but that doesn't mean you're right? You cannot say this is conservative, so it's a better estimate. Aparajit?
But if I sell off $3 billion worth of real estate, will the price go down significantly?
Let's assume the $3 billion is built in a liquidity discount, all the issues. So let's assume that the practical issues have already been dealt with. Right?
But also, again, what am I? Am I a
That's up to you to decide. If you're Eddie Lampert, you know who Eddie Lampert is, right? He's the guy who controls Sears right now. If you're Eddie Lampert, which one would you use?
If I'm an LBO guy, then I buy.
Forget about LBO guy. If you control the company, then you're going to use the higher of the two values, because you control the destiny of the company. Then hope and pray that somebody hasn't screwed up on the $3 billion valuation. But if you're a passive investor, what did you use? You don't control the company, right? For you say, well, I don't control whether this becomes real estate holdings. You're actually going to use a weighted average of the two numbers. Do you see why? You're going to assess a probability that somebody like Eddie Lampert will show up and liquidate the firm for $3 billion. That might be only a 20% chance, or a 10% chance, or a 5% chance. You're going to take 20% of $3 billion, 80% of $2.5 billion. Your expected value is going to fall somewhere between those two numbers, because you as an investor have to make that judgment. This is something we're going to come back to and talk about in terms of the expected value control. We do this with every company almost implicitly, is we build into the stock price or the value the expectations of the company to be run by somebody different. Kevin? They could be. It depends on how the transaction is triggered. But if you're a lender to the firm, you're probably going to be happy about the $3 billion liquidation because you get your cash today. So if you were allowed to make a decision, you'd probably push him towards the $3 billion, which actually works out here in both your best interests. You know when it's going to be an issue? Is the liquidation value is $2.2 billion. The going concern value is $2.5 billion. You as the lender would rather they liquidate and you get your money out, but the people running the firm would rather that go on. And then you have a potential conflict of interest that might drive the two sides apart. Any questions? So make sure you don't double count assets and be realistic. I mean, one of the other thing that I've talked about here is overfunded pension plans. No longer even an issue at companies, but it used to be 10 years ago. The market went up. You had funds. You know how overfunding is computed, right? When I say an overfunded pension plan, what am I saying? Accountants compute the present value of your pension liabilities. So there's a number, $1 billion. Then they look at what you've set aside to cover those pension liabilities. So if you have $1 billion to cover $1 billion, it's a fully funded plan. If you have $2 billion to cover $1 billion, it's called an overfunded plan. Technically, that extra $1 billion belongs to the equity investors. The reason I say technically is there are two impediments. One is if you try to take the $1 billion out of the pension plan, there's a tax penalty that kicks in. I think it's a 55% tax rate on money you take out of a pension plan. The second is the minute you do that, you can kiss labor relations goodbye at this firm for the next 10 years. Because the unions are going to say, you're pulling money out of our pension fund. So practically speaking, it's actually very difficult to extract the billion out of the overfunded pension plan. So let me ask you a question. You have two companies, look exactly alike. One company is a fully funded pension plan, the other is an overfunded pension plan. You know the company, the overfunded pension plan is in better shape, right? Everything else about them is the same. So how would you reflect that in your valuation? Where would you show it, that they're overfunded, that they have an advantage? When you do the cash flows, you have to set aside contributions to your pension plan, right? If you're overfunded, you're going to set aside less cash each year. You're going to have more cash left over. You're going to build in the premium through the cash flows rather than artificially saying that extra billion belongs to me, because that's not going to happen. So I'm not saying don't bring in the advantage, just bring it in a more subtle way than just counting the difference as part of the equity. So other assets, be careful. Don't double count assets. If something is truly unutilized and sitting out there and you can see it, and you can see what the value is, add it onto the value of your discounted cash flows. Next loose end. I'm going to come to you with two companies here, and again I'm going to describe these two companies, and I'd like you to think like investors. Don't think like analysts, don't think like appraisers, think like investors. The two companies look exactly alike in terms of numbers. Same operating income, same tax rate, same return on capital, same growth rate, same cost of capital. So financially, the two companies look exactly alike. But here are the differences. The first company is in a single business. The second company is in multiple businesses. The first company has a very simple holding structure. The second company has all kinds of cross holdings and messy stuff going on. The first company has transparent accounting. What you read is what you get. The second company has very opaque accounting statement. You know what an opaque accounting statement is? You read the 10K and you're not even sure what language it said. It claims to be in English, but you read and you have no idea what it's saying. Then you read it again, you get even more confused. It's obvious that the people writing this 10K were writing it to confuse you, not to inform you. Okay? So simple company, complex company, everything else about them is the same. Here's my first question. If you are doing this in if you adopted any conventional valuation approach, cash flows, cost of capital, what's the value would the two companies be worth? Exactly the same. Cash flow, cost of capital, growth rate, exactly the same, right? But as an investor, would you attach a discount to one of these companies? And if so, why? You see the questions, the numbers all look alike. Valuation seems to say they should have the same value. But I'm asking you to think like an investor. Does one of these companies worry you more? And if so, do you want to build in the price? Which of the companies worries you more? Company B, right? So how come we never care about this in valuation, that we just breeze by this? What are we assuming in conventional valuation that lets us breeze by this issue? We assume that what you don't know can't hurt you. Scary assumption, right? This is a diversification argument. You buy 100 companies, you don't know very much about any of them, it'll all average out. And normally that diversification argument works if you have risks cutting in both directions, right? That's why we can make the diversification argument. But think of the risk you face here. On company B, what you fear is what managers have not told you about the company, right? Let me ask you a follow-up question. What do managers hold back, good news or bad news? How many accounting scandals do you wake up to where the company says, you know what, earnings were actually quadruple what you thought they were in the last 10 years, right? You know what, our cash balance is only 50 billion, not 5 billion. What scares you is that what you don't know is more likely to contain bad news than good news. This is again in the news. I put this example together and wrote a paper on it for the first time in 2001 when Tyco, Enron. And the reason I did this was when Tyco got into trouble, GE stock price dropped 10%. So Tyco got into accounting trouble. There were all kinds of issues. And the next week, GE stock price dropped 10%. You think, what's one got to do with the other? What do Tyco and GE share in common? They're large, acquisitive companies, conglomerates. So what investors were saying is, hey, we got cheated by Tyco. Look at all the things they held back from us. How do we know that GE is not doing the same thing? Clearly the market was discounting complex companies for the complexity. So if we decide to go down this road, though, we face two practical questions. One is we need a measure of complexity, something that tells us that company B is more complex than company A. You can't say, well, I'll know it when I see it. And second, once you've measured that complexity, you need to be able to convert it into a discount. Let's take the first question here. How do we measure complexity? I'm going to give you the most simplistic measure of complexity that I can think of. And this was the first measure I came up with, put it in front of the class in 2001. Here's what I did. I went and counted the number of pages in the 10Q and the 10K. You can do this in PDF format. Do it in PDF. See. Let me ask you a question. These are 10 large market cap companies. If you wanted to avoid a company to pick in your valuation, which company are you going to avoid? Look at this. Citigroup. 1,026 pages to tell me this isn't War and Peace. This is how many pages it's taking you to tell me what happened last year? 1,000 pages? This is one messed up company. You're saying it's all because it's financial services? Let's take, that could be partly it, maybe it's financial services. Let's take two companies that presumably are in the same domain, Pfizer and Johnson & Johnson, right? Part consumer products, part pharmaceuticals. Pfizer has 460 pages, Johnson & Johnson is 218 pages in its 10K. Twice as many pages. What did Pfizer do, at least through 2001, that Johnson & Johnson hadn't done? Two big acquisitions in the previous decade. Here's how I describe it. You do an acquisition, you add 50 pages to your 10K that year, and 35 pages on a continuous basis. You know why? Because the accountant has to tell you why you impaired something, didn't impair. It takes them a long time to say something. 35 pages, continuously. You're a company that grows through acquisitions. You can see the bloat that's coming down the road. 10Ks are going to get what? So I put this up in my MBA class almost 8 years ago, and they weren't impressed. They said, we don't pay this much money to count pages in a 10K. We need a more sophisticated measure of complexity. And I said, you know what, you're right. I'll be back next week. And I came back with what I call my valuation shit list. These are all the things that bug me when I'm valuing a company and how much they bug me. So this is a purely subjective measure of complexity. So here are some examples. A company tells you that they're geographically diversified, but don't tell you where. What the heck is that supposed to mean, geographically? Geography covers a lot of area here, right? Or they tell you they're an emerging market, but don't tell you which one they are. Or they create regions of the world that you've never heard of in any of your classes. I remember when I was valuing BMW about 6 years ago, they had a little pie chart on where they got their revenues. 15% in Europe, 30% in Western Europe, 35% in the US, and then they had 12% in Oceania. So what the heck is Oceania? Where is this? So I called the investment relator. Where's Oceania? And they said it's Australia and Indonesia and all the Australia and Indonesia. What do they have in common? So they're all by an ocean. So what do you mean they're by an ocean? If you use that, 80% of the globe is by an ocean, right? So selective oceans, I guess, But here's the bigger problem. From a valuation perspective, what's the problem when they lump together Australia and Indonesia? Not just growth. We'll talk about country risk. Australia might have 0 country risk. Indonesia might have 12%. You lump them together. What the heck am I going to do with that lumped up number? So that's one thing that bothers me a lot. So I'm going to weight that a lot, throw it into my score. And I did that on different items. Effective tax rate that jump around. 21% one year, 40. You know what that tells you, right? They're playing tax games and they're letting it flow through to their income statement. Deferred tax items, deferred tax liabilities that load out and shrink up. So I put a list together and I came up with a score. The higher the number, the more complex your company. Here, for instance, I've taken Hyundai Heavy, one of the companies we're going to value, took it through, 49.5. There's one problem, though, with this measure. To do this for Citigroup, what should I be willing to do? I have to read 1,000 pages, right? So right after I put this table up, I said, you know what, guys? I don't feel like reading all these 10Ks, but you're valuing a company, right? Just like you are now, they were valuing a company. And I said, you wanted a more sophisticated measure, right? And they said, yes. And I said, okay, let's add one more thing to your project this semester. So be careful what you ask me for because it might be added onto your project. So it's, In fact, that semester, in addition to valuing the companies, they had to come up with a complexity score for their companies and read the entire 10K. The nice thing was at the end of the semester, I got, I think there were 180 people in the class that semester. I got 180 complexity scores. And I actually could look across to see, company the highest complexity score was GE, score of 92. lots of stuff we don't know about GE, and all that stuff is now hanging over the company. But here are some interesting things. We assume that large companies are complex, and there was actually no correlation between market cap and complexity. There were some small companies that were incredibly complex, and some large companies, Walmart, for instance, would be very, very easy. We assume that emerging market companies are more complex than developed market companies. On average, that turned out to be true. But there were companies like Infosys that were actually more transparent, less complex than companies in developed markets. That's one reason when CEOs of emerging market companies use it as a defense. We're in an emerging market, that's why we're complex. Hey, there's nothing about an emerging market that requires you to be complex. Information disclosure laws might be less, but that's putting a floor on what you can reveal, not a ceiling. So if you choose to reveal something, nobody's going to stop you. Companies that grow through acquisitions were much more complex than companies that grew with internal investments. Another reason to worry about acquisition-driven growth, because there are so many more things you can hide when you do acquisitions. And here's a final factor. Any company with a capital arm was about 20% more complex than a company without a capital. You know what I mean by capital arm, right? GMAC, GE Capital. What is it? I mean, some of you are actually valuing companies with a capital arm. What is it about having a capital arm inside your company that makes valuation difficult? It's like having a bank embedded in a regular company, right? Without a dividing line. I mean, they claim to tell you where the debt is, but how do you know? Money is fungible. So it makes it much more difficult to do valuation when you have a financing arm embedded in a company. So you can go the simple route and count the number of pages in your 10K. Trust me, as you go through your valuation, you will get a sense of how complex your company is. And you know what? What I'm trying to do is give you an outlet for your frustration. So after you're done with all of this, think of all the hours this company cost you in terms of how they provided information. And at the last stage, you know what you're going to do? You're going to discount it. It'll make you feel a lot better about that frustration to just knock 25% off the value of the company. Okay? So the last stage is once you've come up with your complexity measure, how do you bring it into the valuation? And here are some things to think about. In a discounted cash flow value, I mean, you can take the aggressive analyst route, which is to trust everything managers tell you. Brown paper bag out of $3 billion, you take it as $3 billion. You can go the other extreme and say, if I don't see it, I don't value it, but then you're not going to stay an analyst for long because then you're never going to buy a company with multiple holdings. So here's my measured response. If you want to bring it in your valuation, there are only three places you can put it. You can put it in the cash flows, you can put it in your growth rate, or you can put it in your discount rate, right? How would you put it into your cash flows? You'd have to take the cash flows of a company like GE and knock them down because they're complex. But knock them down by how much? No man's land, 5%, 8%, 10%. So that's never worked for me. Growth rate. What were the two things that drove growth? I mean, from a fundamental perspective. Return on capital and reinvestment rate, right? And for growth to have value, return on capital has to be much higher than the cost of capital, right? And why, when we see return on capital higher than the cost of capital, what's the underlying factor? Company has significant competitive advantage. You understand the company, right? Let's say you're working with a complex company. Excess returns right now are 8%, but you have no idea what they do. They just seem to make a lot of money. You know how you're going to reflect in your valuation? If you don't know why they're making the 8%, how can you assume that that 8% is going to last for the next 10 years? Fade the excess returns very quickly, basically saying, I have no idea what the competitive advantage is because this company is too messy. Those 8% excess returns are going to go to 0% in 3 years. It's amazing how much of your value will start melting away if you make those excess returns zero. I mean, we've got to start smoking managers out of this process. Basically, if you attach lower values to companies, say, if I don't know it, I can't attribute this for the next 10 years, you're going to get a lot more information come out from managers. Because as long as you accept them at face value, what's the incentive for providing the information? As a final piece, just to see how much complexity mattered, at the end of the paper, I ran a regression. Don't read too much into this because this looked at only 100 companies, 100 largest market cap companies. And I ran a regression of the price to book value ratio for these companies against three variables that are pretty standard: return on equity, beta, and growth rate. But then I threw in a fourth variable. I threw the number of pages in the 10K. How would you read this coefficient minus 0.003 on that? What is it telling me? Every 100 additional pages in your 10K, what happens to your price to book ratio? It goes down by 0.30, right? What's Citigroup's price to book right now? Close to zero, actually, but a little above it. Let's say it's 0.5. I have a very simple plan to make it 2. You know what they need to do, right? They have 1,000 pages in the 10K. If they can make it a 500-page 10K, they're home free, 0.5, 1.52, right? which actually sounds facetious. What are we just telling them? Narrow your business, focus. In other words, what they did in 98 by creating Citigroup has not worked. It's created a mess of companies that nobody understands. This is an argument for focus, right? So in other words, if you're one of those people, what's the strategy word? What was a big buzzword for this? I forget. Core competence, for something like that. You could put a strategy word on this if you want. But this basically says if you stray into multiple business, there's a penalty you're facing. In fact, in finance, there's a complexity discount, or I'm sorry, conglomerate discount that's been fairly well established. That conglomerates trade at a discount about 7 to 10% on the underlying businesses. This may be one reason for it. You just get too messy for people to understand. They're going to start taking it out on your stock price. So that's how complex you are. Fifth loose end. Let's talk about debt. Right? When we talked about cost of capital, the rule for debt was very simple. Be careful what you call debt. Don't start putting everything into the debt, because if you put everything into debt, you push up the debt ratio, you lower your cost of capital. That's why we chose only interest-bearing debt and only leases. Right? We look for fixed payments, tax deductible, loss of control. We stop there. And we said underfunded pension obligations, underfunded healthcare obligations, don't put any of that stuff in, because in doing it, you will lower your cost of capital. However, the rules change once you value the firm and you're trying to decide what debt to subtract out to get to the value of equity. Okay? Let's take a first issue. What did cost of capital? And we said, when we talked about weights, we said always stick with market value weights, right? Market value equity, market value debt. Let's see if that rule still applies to get from the value of the firm. So now we're talking about, you've already done the present value, come up with the value of the firm, you're talking about what debt to subtract out to get to the value of the equity. And let me make the choice stop. Let's suppose you come up with a value of $1 billion based on discounting the cash flows of the cost of capital for the value of the firm. This firm has $1 billion in face value of debt outstanding, but the market value of this debt is only $500 million. You see what the question I'm asking you is, what's the value of equity in the firm? Should I be subtracting out $500 million from the billion, market value of debt, to come up with the value of equity of $500 million? Should I be subtracting out the $1 billion of face value? After all, that's what they really owe, from the value of the firm to come up with the value of equity of 0? Or is there some other answer here that I'm missing? Especially with distressed companies, it's going to be a big issue, right? You come up with the value of the firm, book value of debt is going to be much higher than the market value of debt. Now that we're talking about subtracting things out, should we be subtracting out the book value of debt or the market value of debt? Yes.
That's your obligation.
But how do we get the market value? How do we come up with that $500 million? What do we do? We're taking the obligations. We're acting like we pay them, right? Because we take the promised payments and we discount them back at a risk adjusted. So we're not saying we're not going to pay them. We're just spreading it out across time and reflecting the risk of the company. It's actually one of the messiest issues in DCF valuation. And my answer is going to be measured. If you're doing a DCF valuation, you're implicitly assuming, what about your company? That it's going to close down tomorrow or keep going. They're assuming a going concern. If you're making a going concern assumption on your cash flows, you have to make a going concern assumption on your debt. You're not paying the debt off today. You're paying it off across time as coupons every year for the next 10 years in face value. I know it makes you uncomfortable. It makes me uncomfortable. But here the answer is actually to subtract out the market value of debt to come up with the value of equity, if you're doing a DCF valuation. If you're doing a liquidation valuation, all bets are off. Let's say you value all the assets. I can sell them for $1.2 billion. There you're going to subtract out the entire billion, because here you don't have a going concern backup. You have to pay the debt today and you owe the billion. So you actually have two values for equity, right? $500 million for equity as a going concern, $200 million for equity in liquidation, but two sets of rules for debt depending on which one you're doing. So if you're doing a DCF valuation, stick with market value, even if that market value is less than the face value, because you're not saying you're not paying the debt off. You're just discounting those payments back at the higher default, the higher cost of debt, reflecting default risk. Here's the other rule I would change. Remember how I was very careful about what I defined as debt for cost of capital? When I talk about debt to subtract out to get to the value of equity, I'm going to throw in every concern I have. If I have an underfunded pension obligation in a company, should it bother me as an equity investor? It should, right? Somebody's got to make up the difference, unless, of course, the government bails me out. But if I don't have that fallback position, even though I did not count it as debt for cost of capital, I should be subtracting out to get to the value of equity, because those cash flows have to be set aside. In fact, I'll go further. Let's say you have a lawsuit against a firm. It's a multi-billion-dollar lawsuit. And there is a chance I could lose this lawsuit and end up paying hundreds of millions of dollars. This is my last chance to bring that in as well, right? In fact, many companies, which, this happened with Research in Motion for 2 or 3 years when they were sued by somebody saying that they'd used the BlackBerry patent that they'd stolen from somebody. It happened at Merck with Vioxx. For a couple of years, the big thing hanging over the value is, what is the chance that they will lose the lawsuits and how much will they lose? I know this is very difficult to do, but if you're valuing a company with a lawsuit hanging over its head, you know the most important question you have to answer is, first, what is the chance I will lose this lawsuit? Second, what will I pay out if I lose this lawsuit? How will you get the answers to those two numbers? Don't ask any finance people. This is nothing to do with finance. This is about the legal system. And the legal system, especially in the US, is far too messy for you or I to even deal with it. Pick up the phone, call a trial lawyer. Because this is really about, because I mean, a lot of people say, well, what's the chance of losing? It's not one case, right? It's multiple cases. There's appeals processes. You got to work through the entire process, which means this is really a legal question rather than a financial question. So if I were a lawyer and I wanted to start an investing business, we'll be investing in companies with big lawsuits, and the competitive advantage I'd bring to the process is, hey, I can assess the likelihood of losing these lawsuits and how much it will cost much better than the average analyst. Let me bring that into the stock price. So if any of you lawyers, there's an open area for you, right? Yep. Only partial. I mean, insurance is actually, unless it's an explicit cost, so you can get insurance, but if it's like one of the tobacco lawsuits, no insurance company will even get in the way because the penalty could be $15 billion, right? So some of it can be insured, but most of it is not going to be uninsured. Yes? They'll give a contingent. Sometimes they will either, but that you got to be very close to the. So there is actually a tipping point at which it'll show up. Most of the time, if you look at Merck's balance sheets over those 3 years, nothing showed up. It'll show up in the footnotes, but it'll usually be words saying we're in the subject of a lawsuit, we could lose it, we could lose a lot of money, but how much money is not even mentioned. So it's actually a very messy process bringing it in, but if that's the big thing hanging over your company, you have no choice, right? I'm going to get the last step started, and then we'll continue on this on Monday. Last loose end that I want, there are lots of loose ends I haven't done, like synergy, we'll come back to that. The last loose end I want to kind of look at is options issued by a company, and especially to their own managers. Right? Here's why options matter. When you grant options, it's not the dilution effect that should bother you, right? You issue shares, there's a dilution effect. So if you issued shares and you got the market price for those shares, it doesn't affect your value per share. What makes options different is, first, they're given away. Second, the strike price is set up front. So they get exercised only if the stock price is higher than the strike price. It's not the dilution, the number of shares going up. It's at the price at which you have to issue these shares that should bother you. And there are two things that I want to deal with equity option. I want to deal with them separately. One is, you look at a company, there is a legacy cost, right? This company might have been issuing options for the last 15 years. There are options outstanding today. I have to figure out what to do with those options. Here's the second problem. These companies are not done. They might continue to issue options in the future. I've got to figure out what to do about future option issues. How do I bring them into the analysis? You take a company like Cisco. Both things are still live. They have huge options overhang left over from the past. They're continuing to issue options. You take a company like Amazon. You worry only about the option overhang because 3 years ago they stopped issuing options altogether. Same thing with Microsoft. So I want to separate the two issues and talk about what's the best way of dealing with the option overhang and what's the best way of extending that out into future option issues. So when we start on Monday, we will start with that issue. But on Monday, we will also start the DCF. I know we've been waiting a long time to actually value a company. On Monday, we will start on the first of those valuations.